Wir stellen die Information genau in die Mitte. Und wir sind die Ersten, die das machen.
Research is where the money is.
She never heard of selling short.
Weniger als 500 Millionen Dollar.
The most important thing for your viewers, I know a lot of them are in Europe.
Ein Wissensfundament, was sich wirklich jeder aneignen kann. Ich muss das verstehen. Larry, it's really a joy to have you on. I must tell you, we've watched so many of your videos. I'm becoming a Larry McDonald expert, and we know your book. I know dozens of your customers, obviously. And it's going to be your first video with the German customers, really, and interested parties. And what I'd love to do now is to introduce, of course, you, Larry, and your Bear Traps report. First of all, we're all about knowledge transfer, the democratization of investment knowledge from institutional perspectives and also into high net worth and investor perspectives. And in that sense, you are really of the highest value. We have two aims, of course. One is, we'll do it towards the tail end of our call, to look at risks on a year-end basis, 2021. And then I noticed that you look very much like Stan Druckenmiller at 18-month perspectives. I look at up to 36 to structure portfolios. But I must say more about you before we go into all these topics. You have roughly 700 institutional and other customers in 23 countries. I don't know a comparable service. No, and it's weekly, it's intense. Your website is helpful. Really enjoy your website. And very few people know, you quote this, that 68% of all investment returns are substantially influenced by geopolitical factors.
Yeah.
That's got to be a high mark in the last few decades, potentially growing. What is your view?
Yeah, it's probably like 75 now.
You can hardly invest without being aware of geopolitics. Let me get a little bit into your philosophy on your service. First of all, it has to be added, we are similarly positioned. You have analysts not just in the US, obviously, in Europe. You also have analysts in South America. It's probably pretty important for commodity markets, as well as Beijing, China. How does one get to be a complete macro economic, geopolitical, let's say, in a favorable way, freak? How does that happen, Larry? How did you get there?
Well, you know, I'm with you. I want to democratize information. And I remember starting off in the 90s, late 80s on the retail side as an advisor. I was on Cape Cod and I was kind of advising high net worth individuals. And I just remember the whole world of Wall Street was so opaque. I was terrified of, using a Bloomberg terminal. And I think that Wall Street is filled with like two audiences. One is the retail advisor and the client, the high net worth client.
Yes.
And that relationship, which is very social. It's a lot of tennis and a lot of golf and a lot of shows. And I think that the advisor won't tell, because I know I lived through this, the advisor won't tell the high net worth individual about kind of the situation that he's under, because when you're an advisor at a bank, it's like an all-you-can-eat buffet. The chef comes out, and when the chef comes out and looks at the buffet, he doesn't say, don't eat that and don't eat this. He says, I eat everything, right? So your advisors in America, in Zurich, I was just in Zurich and Geneva, they've been very burnt over the last 30 years by banks. And
Absolutely.
It's been like a one-way fire hose. And so what we've done at the Bear Trap Support is we're probably one of the few services, everybody focuses on the retail customer. We thought we'd go the other way. We want to focus on the institutional customer. So we built out that business, and now we're going it the other way. Now we're opening it up to retail and democratizing.
It's affordable, for crying out loud. Well, you often mention, or in our previous calls, we've mentioned the Lehman criteria, 21 Lehman criteria. But let me ask you this, because I've hear and hear again and again that you have two core obsessions. One, as I read it, correct me please, what is discounted in a price? That seems to me a central part. Certainly what risks are not discounted, and defining a sound risk-reward ratio with probabilities. Believe me, those three things are my obsession. But am I roughly right in saying this, that you do the same?
Yeah, it's so important. I mean, it's like, people will say, okay, the inflation numbers come out and bonds sold off a little bit, like 1 or 2 basis points. And then like last week, bonds sold off and then rallied a tiny bit. So ECE came out of the United States. But what the journalists don't tell you is that bonds sold off, 20 basis points into the inflation number. So like the journalists will just report the news and they'll be like stating something, well, bonds didn't really sell off on the inflation number. What do you mean? Of course, they were selling off for 2-3 weeks into the inflation number. So in other words, and then what happened is smart money, when the inflation number came out, covered and bought back bonds on the news. So what's priced in is so important. That's the mistake the journalists make, because journalists are young people, right? I know them all in New York, and
Sure.
some of them older, more mature. Greg Zuckerman's one of my favorite from the
Sure.
journal. I mean, and Robin Wigglesworth in Europe. There's some real veteran good ones, but for the most part, it's a lot of inexperienced people that don't understand markets and they don't understand risk. They don't understand what's priced in. So they report news, and then people get these warped perceptions of risk. Our 21 Lehman systemic risk indicators is a basket that we developed when we were just coming out of Lehman, and it looks at a number of things around the world. And I developed it as our team. When we were at Lehman, I ran a book that helped hedge our loans. So Lehman at one point had 10 billion of leverage loans. So everybody thinks of Lehman Brothers as the bank that blew up with a lot of subprime mortgages. That's correct. But we also had billions of dollars of leverage loans from buyouts that kind of like got hung. And buyouts that's like a leverage buyout deal that the bank's trying to sell to investors and they can't sell it, so they get stuck with all the paper. And my job, I was part of a team that was hedging that. And so one of the things that Mike Gelban used to tell us is you want to look around for hedges where you can hedge the loans. And we would look around, and what's most important is when you see moves in markets. So there's different types of buyers of hedges. When someone owns a lot of risk and say a big pile of $10 billion of leveraged loans, and they see something in the market like a David Tepper, brilliant famous hedge fund.
Yeah.
And when they pay up for protection on, say, credit default swaps, say they're betting against high yield bonds in the United States through an index, when they come in and they pay through the offer side, in other words, pay up, in other words, when they don't care about price, that's a very good indicator, because that means that there's an old saying when I was at Lehman, when we were trying to hedge the subprime mortgage against subprime mortgages, against leveraged loan, we were trying to hedge that money. We would, my old boss used to say, I don't want a nickel and dime. I just want to get done. In other words, when you don't care about price and you're buying insurance, those elephants leave footprints and you can see them on the tape. And that's kind of where we got the concept of the 21 Lehman systemic risk indicators. We look for those clues. The last 10 years, you've had Brexits, you've had austerity and tea parties. So Obama lost the midterms by 63 seats, as you said, in 2010. Republicans came in and they took the spending down big time. That was very deflationary. So the Republicans took it from a 1.1 trillion deficit down to 500 billion, 490 billion.
Yeah.
So that was the first deflationary shock. And then you had the taper tantrum right after that. So the Fed misjudged the impact of their policy. They were the most hawkish central bank in the world in 2013, 14, 15. And so that was the second. And then unfortunately you had the Brexit, very deflationary shock. Then you had the trade war. And don't forget, we did have the Greek crisis in there.
Sure.
So then we had the trade war, and then we had COVID. So we had this incredible, just collection of deflationary forces. And the governments know this now. The Fed has learned from that mistake. That's why you see today, there's at least 12 central banks on the planet that are far more hawkish. I mean, South Korea's hiking rates, Bank of Canada's tapering. I mean, you've got over and over again, all around the world, Brazil is hiking. You've got central banks that are far, far more hawkish than the Fed. The ECB today is on the tape talking up inflation risk, the euro strengthening. So they've really got the joke that the dollar is the global wrecking ball. The Fed is the conductor, like you've seen the conductor in the symphony, and all the other central banks this cycle are far more hawkish than the Fed, whereas the last time around, we had this period where the Fed was the alpha male, hiking more aggressively, and it caused 3 instances of global big drawdowns, which have scared investors out of global stocks, that's why in the last 3 years, it's an amazing stat. We put this in the Bear Traps report yesterday. The last 3 years in terms of ETF flows, 1.3 trillion of net inflows have gone to the U.S. And what that means is you look at outflows versus inflows.
Wow.
So the U.S. is 1.3 trillion, okay? Plus. The rest of the world is 180 billion plus, okay? So in other words, all the money, because of these 6 things that happen back to back, investors globally are just hiding out in the United States. They're hiding out in bonds. They're hiding out in tech stocks, growth. They're all in the same trade, okay? That's why it appears the markets are going up, but the average stock inside the NASDAQ is actually down 20%. In other words, there's a lot of stocks in the NASDAQ and the Russell. They're very low, but people are hiding out in these few stocks, these large cap companies, and that give the perception that markets are moving higher, but underneath the surface, there's been some pain. So the bottom line is what we're going to see over the next year and a half, as inflation is more sustainable, it's going to shock all of this money that's in the growth basket, and it's going to push money into the global equity dynamic versus the U.S. So it's like because of deflation and because of 10 years of these shocks, everybody's hiding out in the United States. That's why the dollar's been very strong for the last couple of years. And so now, that whole dynamic is now really unwinding the other way.
Wow, interesting. I mean, you get better value for money if you take Chinese valuations and not too much central bank money pumping. You even get roughly 3.7% on your deposits, plus the valuation on comparable Alibabas and Tencents and whatever are roughly 30 to 40% of US peer group valuations. Okay, they say there's interference, but there's 62 directives by Biden and co. against big tech in the US also. So, I mean, that fundamentally might make real sense. But technically, isn't this, I mean, for me, it's always been a health market analysis we've seen sharp volatility in cryptocurrencies. We've seen the SPACs meltdown. We've seen a meme meltdown. We've seen broad weakness in the Russell 3000, especially in the NASDAQ broader indices. I mean, without becoming vulgar, to me that shows me a fairly fragile environment which could really suffer through black swans.
So here's another thing. The most important thing for your viewers, I know a lot of them are in Europe. So this is the most important part of the whole conversation. Right now, the millennials as a voting bloc in the United States, the oldest one is 40. And the baby boomers, the oldest one is in his 80s. The last 15, 20 years, the US has been fairly conservative in spending and in policy because the baby boomers were at peak voting years. So 5 years from now, the baby boomers are going to be in their 90, approaching 90. The millennials are going to be 45. The difference between a millennial, and this is in my next book, we've been working on this what the difference between a millennial voter and a baby boomer is like night and day. Millennials go to Bernie Sanders events. That's why Bernie Sanders has 20, 30,000 people at his events. These are all millennials. The problem is millennials at 35 don't vote. Millennials at 45, which is literally 4.5 years from now, they vote. So if you have a dynamic where the Senate over the next 4 or 5 years, becomes more progressive in the House as well, then you're going to have real long-term spending. And remember, the one reason why we've had transitory inflation, I think one of the biggest reasons is the power of labor the last 5-6 years since Reagan.
So important.
Been crushed, right? Labor unions, all this stuff. But if you have this political shift over the next 5 years, and we can already see it this year, it's already happening. Labor is more powerful than ever. People are staying home. They're not, they'd rather just stay out of the labor force than work. Right now, the labor force is almost 6 million people less than it was in 2019. And you're seeing Walmart pay up. You're seeing Amazon pay up. You're seeing all these companies. Uber has to basically give massive bonuses to get people off the beach back into the labor force, right? So that is the power of labor is increasing because of Democratic Party policies.
Sure.
That is very not transitory. That is very sustainable inflation policy. That's totally different than 2010 to 2020. It's a different world.
I think you're ahead of the curve. You should benefit disproportionately in the coming times, and you have to grow really well. I really hope that some of our viewers will take this on and become customers. We're certainly subscribing. And I have no conflict of interest. I just love the talk. Larry, it's been great. Maybe we can follow up on this in 6 months or a year when we talk about NASDAQ and commodity prices again.
Great to catch up. And I'm on Twitter @ConvertBond.
It's been excellent. Wonderful. Thank you very much.
Okay, all the best. God
Cheers.
bless.
God bless.